Today's Animal Spirits is brought to you by Masterworks. City Private Bank has this really long report that they put together that looks at the contemporary art market. And they not only did the returns going back to 1995, they also looked at the correlation factor. So they compared contemporary art to the S&P 500, global equities, gold, and U.S. housing. It's interesting that, of course, it's basically no correlation between equities, but I thought it was more interesting that there's little to no correlation between art and gold or housing. Because if you think about it, art is a real asset, and that's what gold and housing are too, right? They're tangible, real assets. You would assume that there would be some correlation there from an inflation, interest rate, all these other thing perspective, and it doesn't really exist. And so the whole point is that Masterworks' whole point is that contemporary art has this key diversifying factor. And I think it makes sense because I would have assumed real assets would have been more highly correlated together.
Ben, do you have taste in art? Are you like an art guy?
I would say I wouldn't trust my own taste in art. No.
Look at this. Did you buy this Basquiat, this loin one? Painted in 1982. I bought this piece. I would be lying if I said it spoke to me. We got, I don't need to describe it, right? There's a visual show. You can see what it is.
This is why I allow Masterworks to do this for me. They pick the paintings because I don't have an art for this stuff.
Let me say this. These are in a world of fractionalization, which Masterworks is fractionalized, but real-time data on everything. Bitcoin's moving 9% a day. Altcoins moving 30%. Meme stocks, growth stocks, everything's moving way too quickly. It's nice to not see the price fluctuations on these pieces of art every single day. It's like it's one thing in my portfolio that doesn't move on a daily basis. And I should mention to the viewer, these are long-term. Ben, you might be bald by the time we get an exit in one of these paintings.
It's possible.
You might look like me.
And you're going to tell me when I should do it. But yes, they're valued on a quarterly basis, but it's kind of like private equity in that, you don't have to see it every day. And I think there is some comfort in that in a lot of ways.
Illiquidity is a beautiful thing when markets are going south. So, okay, you want to learn more, go to masterworks.io/animal. That's masterworks.io/animal. Please see disclaimers at masterworks.io/disclaimer.
Welcome to Animal Spirits with Michael and Ben. Michael, when we first started talking about the retail takeover of the markets in 2020, the whole idea from a lot of people was, well, there's nothing else to do. People are bored. So there's no sports. People have to pay attention to something. The stock market is the easy thing here. And when things open back up and people start traveling in and doing stuff, you can bet on sports, this stuff will surely subside. Well, that stuff has happened and it still hasn't happened yet. So this is Wall Street Journal had a article about the takeover retail. They said there was 10 million new brokerage accounts open in 2020. Then in 2021, there was 15 million new brokerage accounts opened up. At a peak in the last year, JP Morgan estimates that the number of shares traded on individual day from retail investors was 20% on peak day, or 40% on peak days.
Finish your thought.
No, most of the time they said it's like a third of active daily trading volume, which is a huge number for individuals. Usually it's all the professionals carrying the day with everything.
Not only is the economy reopened, although to different degrees depending on where you are, where you work, etc., but a lot of the names, obviously, right, that we've been talking about for the past few months, that these traders were feasting on in 2020 and 2021 have collapsed, and they didn't disappear. Why? Credit to me. I have been saying that people don't get unaddicted to trading, and I think that these apps and trading in general is very addictive.
And investing, I think if you just start to see a little bit of progress, even though last year may have undone that for people, they said this is this Vanda Track. I think you've used that before, right?
Yep.
So they said in 2021, retail investors purchased almost $300 billion worth of stocks and exchange traded funds, 7 times more than the amount in 2019.
Wow.
And they said that 2022...
Now do options. I bet it's like 100 times more.
So I got to be honest, this does surprise me a little bit that it's stayed. We've had the follow through of people, and I think hopefully that's a good, because a lot of people have been worried the whole time, saying, "Well, they're just on Robinhood and they're addicted and they're playing around and
everything's going up." Right? It was very easy to make the case that these people would disappear once the Zooms of the world stopped going vertical. They did stop going vertical. They didn't disappear. I'd be curious. I know VandaTrack does this data where they track individual investors and what they're buying, what they're selling. If they're not still trying to buy the dips in growth stocks, which I'm guessing they've moved on, I guess to different degrees. What are they buying now? Because I have a hard time seeing the average retail investor, and I have this image in my head, I think the stereotype we all do, even understand that they're not all crazed maniacs, right? Like not everybody is buying options and day trading. That's definitely a broad generalization. But the people that are trading, are they buying energies stocks? Are they buying financial stocks? Like, are they buying these names?
I don't know. They were buying ARK as well.
You know what's at a 52-week high last week?
What's that?
Pepsi.
Okay, yeah. There's no way.
I can't imagine that they're buying Pepsi.
No. Exactly. And they're probably not buying ARK as much either. We've talked about this. I feel like this has kind of reached a crescendo of people dancing on the grave of Cathie Wood because...
Can I jump in there?
Yeah.
I think that even though it's in very poor taste, right? I think that some of it, I'm definitely not saying that they asked for it, but in a way, some of it they asked for. Specifically, that commercial in October 2021, 3 months before they peaked, where they were basically bashing financial advisors for buying plain old boring indexes.
Many investors appear to be afraid of companies that offer newer, faster, cheaper, and creative products and services. Now you can avoid these innovative companies. How? Ask your advisor today if investing in a traditional broad-based index is right for you. A broad-based index provides investors with a feeling of safety and comfort, knowing that they hold past success. Often based on tangible assets like a bank branch, railroad, or real estate, indices should generate predictable cash flows because, hey, that's historically been the case. And things never change. Side effects may include, but are not limited to, owning companies associated with the traditional world order.
And we don't need to show the performance then since now. I think you get the idea.
Right. So it's down almost 50%, I guess, from the highs in February. Again, this thing was outperforming the NASDAQ, as I said in the lead-in, by 500% in total since inception, and now it's like 30 and falling fast. I still think it's impressive. They're up 20, like you say, oh, wow, that's like the meanest of all reversions. They're still up 23% since inception. I think that what we learned is that this is one case where every single financial prognosticator was right.
Yeah, very, very unusual.
A lot of people were saying at the peak, there's no way with the names that they're trading, and these being like smaller and mid-cap names, beyond Tesla that they're really known for, there's no way that so much money can go into this stuff without them harming it on the way out and seeing these, like, they just can't get that big. So
I think everybody wrote a post like this. I wrote "This is not the way" in December 2020 about how easy it is for all of these investors. That was pretty close to the peak. But anyway, I'm not taking a victory lap because literally every single person with a Substack or WordPress wrote the exact same article that this cannot continue indefinitely.
So Jason Zweig wrote one on this too, and the numbers are pretty insane.
Well, there's two things here. One is that it's not necessarily a tidal wave. Like Balchunas had a chart showing the daily inflows and outflows, and Balchunas said ARK, with the biggest outflow since March, has seen $500 million out in the past 2 days. However, it took it about $500 million in the 3 days prior. So he said this in and out of flows matched with over $1 billion a day in volume, a silver lining for ARK, shows more of a tug of a war than an exodus, as Balchunas predicted. But then Jason Zweig shows these are estimated net flows. It looks by month, and they're heading for the exits. So in this article, Jason told the story about money weighted returns, and this is inevitable. This is definitely not Cathie Wood's fault or ARK's fault or anybody's fault. This is just what happens with investors. So they're talking about money weighted returns, that they kicked butt in 16, 17, 18, but the money didn't really start pouring in until 2020. So the assets tripled. This
Those numbers surprised
ARKK.
me. So he said that in 2016, there was $12 million in assets.
12 million.
12 million, that's nothing.
Yeah.
Even by the end of 2018, it at 1 billion. So the fact that it got to 40 billion or something, and it happened so fast, again, you can't blame the portfolio manager for that, but when you get that much money, there's nothing you can do. And I think they've kind of trapped themselves because the right thing to do would probably have been to close the fund.
But they can't close an ETF, can they?
I think you can close an ETF. You can't do that?
No.
Because it's traded secondarily? Okay, maybe. But
what happened was,
even if you could close it, because she's saying that this opportunity set is so big and they can do 40% per year, like you would have to assume that if the opportunity set is that big, that they could handle all these flows, which they obviously can't.
But her style has migrated. It's same premise, but they were in medium-sized names, and now they're in the biggest of the big, because when you get to $40 billion, you can't buy tiny names. So the fund assets tripled to $6 billion between March and July 2020. From September 2020 through March 2021, Morningstar estimates that investors poured in $13 billion. And as a result, Simon Lack estimates that ARK investors as a whole have lost money since it launched in 2014, even though the fund gained an average of more than 31% annualized over the past 5 years. And this is a chef's kiss quote from Simon Lack. He said, they called this the unfortunate downside of human behavior. No matter how desperately you chased past performance, you will never catch it. That's pretty spot on.
I guess for as crazy as things have been in the market, this is not to again, I don't appreciate the people like dancing in the grave of them because their performance has still been awesome.
Yeah.
But this is one of the things where there's been so many things happening in the market these last 5 or 6 years of this cycle that just make no sense. Whereas this, when you look historically, this is exactly what happens to every single one of these funds that gets too popular and has too much money committed. So it's honestly almost nice to see like a historical analogy actually work for once in the last 5 years.
A good lesson is don't be a dick on the way up. And again, I'm not saying that Cathie Wood was a dick, but that commercial was a bit of a jab. I remember
it was a heat check, basically.
It was. I remember, I remember listening to Chamath in 2020 or 21. I can't remember. Maybe it was with Patrick. He was on Patrick's podcast or some podcast, and he was like all these stupid value investors. And when you talk like that, you're putting a bullseye on your back, and I'm hard to say that he doesn't deserve some of the heat that's being thrown his way.
Yeah. Okay. So you saw the thing by Aswath Damodaran, right, where he breaks down the market cap of the world stock market. This one is surprising to me. So I think there's different ways to break it down because if you look at like a total stock market index of the world, the U.S. makes up 55% or so, something like that. And I think the way he showed it, it's more like 40%. And I think some of it is a lot of these shares overseas don't get traded. But this surprised me. So he said the United States is worth this is as of the end of last year, 2021, $52 trillion for the United States stock market. China is like close to 19 or 20 trillion. That's way bigger than I would have anticipated, right?
Even after getting hit. Wow.
Isn't that kind of surprising to you? It's that big?
Yeah.
Especially since their performance has been so terrible and they seem to not want their huge tech stocks they basically crash them on purpose.
So people have asked, I think we got an email recently, why is China still considered an emerging market, even though they have one of the biggest economies, one of the biggest stock markets? And a lot of that has to do with the political infrastructure, obviously.
Right. They seem to not want high stock market returns, whereas we definitely do. Right? Like they seem to want to put a cap on them for some reason. They don't want they don't want their own Elon Musk or Jeff Bezos over there.
Damodaran put 4 things in here, sort of some lessons or takeaways. I don't remember how he described them, but I wanted to go through them because I thought they were very interesting. He said, more data is not always better than less data. We as investors and analysts are drowning in data, and that data overload is now a more imminent danger than not having enough data. I think this is like the bell curve meme where it's like the genius, the moron, and the overthinker in the middle.
Yeah.
I think that's kind of what's going on here. Like unless you are like a high frequency trader or Renaissance or whatever, how much do you really need to know about a company before you're just going to start confusing yourself?
Right. Or the market or any strategy in general, I guess, right?
To that point, number 2, data does not always provide direction. As you work with data, you discover that its messages are almost always muddled and that estimates always come with ranges and standard errors. You know that scene in Princess Bride where the guy is debating, like, did you poison the wine? Did you not poison the wine?
Yeah.
And he just talks himself into a circle.
Yes, exactly.
That's how I was this weekend, by the way, with my FanDuel app. Can I tell you what happened? Betting stories are the worst, but just real quick. There was one prepackaged.
No, I don't mind betting stories as long as it's like a losing story. Those are the best.
Oh, it's a losing story. Yeah,
Okay,
we'll not share any victories. Sorry, I lost my train of thought. Oh, it was a prepackaged bet. So I open the app for the 1:00 game on Saturday, and I see Mike Evans touchdown at any time, Gronk touchdown at any time, Brady over 270 passing yards, and Scotty Miller over 8.5 yards. So I said, yeah, I'll throw through a few.
I would love to see how much money those apps make on parlays because
throw a few shekels.
Those things are just losers every time almost.
All I do is parlay. I'll throw a few shekels here. By the way, I bet on every single game for the first touchdown scored, lost every single one.
Of course.
Because the odds are just too titillating. So anyway, that particular bet was 20 something to 1. I put a few bucks down, and Scotty Miller had one catch for 8 yards. Every other one hit. He had to, it was the over under for Scotty Miller was 8.5 yards.
Ooh.
And as I saw that one catch, I'm like, I'm pretty sure that was 9 yards.
I'd like a replay, please.
Pretty sure it was 9 yards.
Oh man. This one from Demoter and I thought was also good. He said, mean reversion works until it doesn't. Someone sent us a John Hussman piece, which I don't, I'm sure he's a nice guy. I don't know why people still read him because he's been saying the same thing since 2010. But they're asking us, what do you think about this? Because it said, if valuations go back to where they have from prior peaks to prior troughs, the S&P has to lose a minimum of 70%. And he's been saying something like this for the last 13 years straight.
I'm sorry. You know why this really grinds my gears? I remember, I think I was on my honeymoon in 2013, and I read this post from Henry Blodgett, and I think Hussman has been like his Sherpa. I don't know if I'm using the word properly, but has been his guide in terms of why the market is going to crash.
Do you think Blodgett is reinvesting his dividends yet? Do you remember that was an all-time Twitter moment? He said it was 2014, and he said he's worried about the stock market. He said, you know what? I'm going to keep investing, but I'm not going to reinvest my dividends.
I'm sorry. I'm not going to say anything. I'm not going to say anything.
I know, but that was...
my mother always told me if you have nothing nice to say, don't say anything. I'm not going to say anything. But that post pissed me off because I felt a little bit of, ooh, wait a minute. That got to me. I was a little bit nervous after reading that. And I think the reason why that stuck with me so severely is, well, obviously, given what the market did, how could it not? But I could only imagine how many people read stuff like that and blow up their portfolio, blow up their long-term returns and just get totally corrupted and poisoned forever.
I first read him in 2010 or 2011, and I was like, this guy's the smartest guy in the world. Everything he says must be right. And he's been wrong every year, and he just doubles down and hopes that eventually betting on red every year is going to win. But the markets don't really work like that. So Sam Rowe had one on his ticker Substack where he talked. Goldman did this work on CAPE ratio, which is probably essentially what Hussman's analysis really.
Can I say thank you to Sam because he quoted me in that post? He called me blogger extraordinaire. Never been called that before. I appreciate that. Very nice.
Very nice. I must have missed that. He just Goldman. This report just said we've found no statistical evidence of mean reversion in equity valuations. He's like, there's some upper bound where they can't reach infinity. And there's some lower bound where they can't go below zero. Anywhere in between there, though, there's no long-term mean that they revert to. It's a moving target, essentially. And you're not, by saying I'm going to wait until they come back to here, whether it's lower or higher, that just doesn't exist. It doesn't exist.
I'm sure there are obvious answers to this. I can't think off the top of my head, so don't dunk on me in the comments. But what are some things in nature that, by law of physics, are mean reverting?
You ask me to do some science here. In the markets, there's nothing. That's the thing. Your range is so large that if you think I'm going to get the exact average in the middle, and that's what I'm going to wait for, it doesn't. The markets don't work like that. Unfortunately, it would be a lot easier if they did, but they don't. And that's why waiting for a 70 or 80% crash in the S&P so we can get back to 10 times earnings. I don't know. I'll see you in 2047 or whenever. It's
all right. Last one from Demoterin. The consensus can be wrong. A few months ago, I made the mistake of watching Money Heist, a show on Netflix based upon its high audience ratings on Rotten Tomatoes. And as I wasted hours on this abysmal show, I got a reminder that crowds can be wrong and sometimes woefully so. This struck a chord with me because my father will not stop talking about this show until I watch it.
Okay.
And I haven't watched it
He's
yet.
right. I watched one episode and I'm like, this is horrible. I stopped.
Okay. No offense to my dad, but I'm pretty sure that you and Demoterin are right and he's wrong. But in fairness, because I do love him, I will try it. But I just...
You know what's another one that got me that a lot of people have been recommending forever to us? Lupin on Netflix. I tried it for an episode. Nothing. Didn't do it for me.
Well, hang on. Don't be that guy. You can't write up a show after one episode. You could say it might not be for you.
Do you know
but you can't...
Do you know sometimes you can tell just the tone of a show is not going to be for you personally? Just the overall tone, whether it's the...
Totally.
That was it for me. The tone of that show didn't do it for me.
Fair. I watched the John Cena show. What was the Suicide Squad? I love that movie. Tons of fun. I watched the first episode, and I'm pretty sure I'm out.
I could tell that from the poster for that one for me, but you're more of a comic book guy than I am.
Yeah. But even though I'm being hypocritical, I'm going against what I just said. My point is, you, sir, cannot say that a show is no good just because you watched one episode and didn't like it.
Well, it's all personal taste.
You can say it's not for me and I'm out, but you can't cast judgments after one show.
That's why there's a difference between, I always say there's a difference between best and favorite. If people would just say this, instead of saying this is the best show ever, say it's my favorite show ever. And that solves it all.
You just fixed the internet.
Yeah, but that's no fun if you do that though, right?
Yeah. I just want to say one more thing on this demotoring piece. We're going to link to this. The investor resources that are available today is remarkable. Ben, you said earlier in the show that you started your career calculating returns by hand.
Right.
Demotoring has this resource where he has these risk measures, beta, standard deviation of stock price, regression statistics, stuff like that, profitability, returns, cost of funding, financial leverage. And each of these has a hyperlink where you could download data and comb through all of this. None of this was available back in the day. The amount of data, now it could be overwhelming to his point about data overload, but the investor resources, there's no shortage of places to learn these days.
I did a post, I should update this. I did a post like 5 or 6 years ago, like my best free investment resources, and one of them was his. He just posts every single year the calendar year returns for the S&P 500, the 3-month T-bill, which is effectively like a savings account or cash, the 10-year treasury bond, and then he also updated it to include real estate and like triple B corporate bonds. And he also adds the inflation rate in there. And it's just annual returns. And I use that thing for my blog maybe once a week, it feels like, once a month, all the time.
Really? I never use it. I should add that to my free resources list.
It's just annual historical returns for stocks, bonds, cash, and real estate. And it shows like the growth of $100, all this stuff. It's very useful. I use it all the time. Here's a good one I thought was worth reading. And I want to mention, Michael and I did another appearance on Derek Thompson's Plain English podcast where we talked a lot about the economy.
What a thrill.
And inflation.
What a thrill.
We're regulars. But I thought this post was a nice addition to what we were talking about. And it's by this guy, Darlow Perkins. And he the whole post, the name of the post is, hang on. Oh, don't extrapolate.
The name of the post is hang on.
Don't extrapolate from this fake business cycle. The name of the post is my internet's a little slow today. And he says like a lot of the confusion of people who are trying to figure out where we are in the cycle is just like, he's saying throw that out. Like, what inning are we in? Because he's basically saying the recession was fake. The recovery has been fake. All of it is like, and it's kind of true. He's like, listen, we went into recession not because of some macro instability or some shock. It was chosen by policymakers. And so trying to say, are we early, mid, late cycle, whatever? Like, he's like, you have to throw that all out the window.
What year? Maybe we spoke about this. Maybe even recently. What year did Silicon Valley premiere? You know what year that was?
2014, maybe.
2014. You know what inning that was?
26.
The 13th. Yeah.
Yes, but he also said, and we talked about this with Derek, he said, GDP in most parts of the world is roughly where it was expected to be in the absence of the panic. So people trying to say we're overheating, he's like, compared to what? Yes, compared to a huge trough in the spring of 2020, but compared to the trend line before, we're actually back where we were. And so he's like, so he's saying like this whole overheating, it's impossible to say because this was a manufactured economic cycle. And I believe that too. So he's saying the risk is policymakers make a mistake based on this.
You know, when you just said the word trough, for some reason I thought of the trough at a football stadium. It's probably one of the most barbaric things in the world is urinating into a trough. I did that one time at Ralph Wilson Stadium, maybe 15 years ago, where the Bills play. Just a totally.
You ever been to a game at Wrigley Field before?
At Wrigley, no.
I mean, the trough is probably from 1915. The grossest thing you've ever seen in your life. Just and when all the people and all the guys in the bleachers are 7 beers deep, and there's no aim. I mean, it's the grossest thing ever. Just a huge
Pittsburgh.
tub.
I went to football, Heinz Field. They also do troughs, I believe. Anyway, enough with the troughs. Retail sales missed. Not exactly sure what that's about, but dropped by 1.9% in December. Although, interestingly, still 17% year over year.
Look at the chart I have in here on retail sales and tell me like if it shouldn't drop some. If GDP is back on trend, retail sales is so far off trend. Shouldn't we? If mean reversion does exist, it should probably exist here.
Yes.
Like, shouldn't we expect this? This is so bananas how high it is off of trend.
I'm just staring at this chart because it's truly unbelievable.
Yes. If you want to know why we have a supply shortage, like obviously there's pandemic related stuff and labor shortages, but this is got to be account for like 2/3 of it at least. Just people spending so much money.
So maybe the miss was because people shopped in advance of Christmas because these are December numbers. Probably too early for Omicron. But either way, looking at this chart, it's hard to get too worked up over this.
The great things about seasons is that you can always say it's probably seasonal, right? Because that sounds smart when you say it's seasonal.
Yeah, totally seasonal. Totally seasonal.
Blame it on the
Somebody asked us, why is the housing market included in the inflation number, but not the stock market? What would inflation be if we included the S&P? Well, the reason why the S&P 500 and the stock market is not included in
because it would be your inflation would be negative.
Well,
because people are getting richer. So
good take, good take. Well, but if you use like how much does it cost to buy the stock market? You remember they used to do the comparison of hours of labor compared to, that was a chart crime, I believe. But because it's called the consumer price index. And in my opinion, anyway, stocks should not be included in the consumer price index.
The CAPE ratio is the inflation. Prices. The CAPE ratio is the inflation indicator of the stock market. How's that? It wouldn't make sense. But that's also why I keep coming back to this idea that the housing market for those who own a house, it makes inflation so weird because if you're buying your first house, you're feeling big time inflation in housing because your rent probably went up as you were waiting, and the cost of your first time home is way higher than it would have been. But if you owned a home, then it's up in value. So how is that inflation? Because it's worth more to you in your pocket. That's deflationary.
The stock market would be a huge component of CPI if it was in there. It's interesting to think about. Yeah, but how many people? Half the country doesn't even own stocks. I guess Ben goes back to your point of inflation being very personal. National averages for these things are sort of don't throw them out the window because they are indicative of what's going on. But
I wrote a post this weekend about this. You can essentially throw that when it came out last week that the inflation was 7.1% or whatever it was. It's so funny because even when it's high, people say it's got to be higher because of this, and no, it's got to be lower because of this. And if we take used cars out, but if we add in owner's equivalent rent or whatever it is, the average is never going to be right for exactly even one household in the United States, probably, because consumption patterns are so different in what you're focusing on and what your stage of life is that that average is essentially worthless, and the only thing that matters is probably the trend. Because even if you took used cars out, like I think I saw so if 7% is inflation, 1% of that 7 is used cars and
so
new cars.
Still absurdly high.
That's the thing, the trend. So even if you took that out and used cars weren't going crazy, it would be 6, which is still higher in a trend going up. So I think that's the whole thing, even if you break down these components. But by the way, back when they didn't have this stuff to be able to break down in components, do you think people just didn't care or didn't know that this was the data was even happening? Like back in the 50s.
Oh, no, they definitely knew. They definitely knew. Come on, they're not cavemen.
Kind of, though. You didn't have the internet. You didn't, you didn't see
this stuff
went
to the store.
But you didn't have Twitter scrolling 30 seconds until the inflation number comes out.
Fine, fair. But inflation was the story of the entire 1970s. Or I should say the biggest story. That and Watergate, probably. So True. Don't tell me that it didn't matter. Okay. Or they didn't feel it.
So speaking of inflation, I'll tee you up here. How high would Netflix have to go for you to say, I'm out?
All right, let's get into this. Well, to answer your question,
I've been a customer with Netflix since I was receiving DVDs in the mail from them. I've been paying for Netflix. Yeah, probably earlier than that. Probably 2005. I've been a customer for Netflix for so long. When they gave me streaming, I remember saying, "Hey, we're gonna attach streaming to your DVD thing." I was like, "Oh, cool, whatever." I care more about the DVDs. I'm getting 4 discs a weekend or something. I'd get 4 or 5 Sopranos discs or whatever show I was watching.
Let's get into how shitty was. There was something. It's fun to look back on Blockbuster. Blockbuster was not fun. When you would walk up and down the aisles for an hour trying to find something, you ended up picking out a bad movie. If you wanted to see Gladiator because you missed it in the theater when it came out, there was 15 of them and they were all gone by the time you got there.
Yeah, then you'd have to go up to the desk and go, "Hey, did anyone return Gladiator yet?" And the guy would have to sort through them.
Yeah, hold on, let me say. Yeah, it was horrible.
Yes, it was awful.
All right, so Netflix is raising prices. The company's standard plan will rise to $15.50 per month from $14. Let's see. So they've raised prices. They've raised prices throughout the years. There was one in 2017, then 2019, then 2020, now 2022.
here's the reason why Netflix is so worth it. Even though sometimes like their TV shows, like they've been lagging, I feel like, in having high quality TV shows of late. They just more go for like quantity over quality. I feel like whereas like HBO, you can know like almost every time it's gonna be good, but there's zero latency when you log on to Netflix and you click on something. Because I've been trying, I have every streaming channel there is now. We talked about this the other day, watching 1883 on the Paramount Plus.
Still can't find it. I still can't find it.
You get this bar across your screen as it's pre-rolling, and then you have to watch a commercial on there, even though you're paying for it. Showtime, I've been watching Yellow Jackets, which I want to get to in recommendations. There's no skip intro button on there yet, still. And then when you go to roll in right to the next episode, they show you the highlights from the previous episodes. It's like, no, I'm binging this. I don't need to see the highlights. I just saw that episode. Whereas Netflix, everything is so seamless, and they take all that junk out and just make it easy for you to watch as much TV or movies as you possibly can. Like, their quality is so much higher than any other streaming network channel.
So is their, oh, you mean the quality of their streaming, the actual streaming?
The actual experience, the user experience is by far the best.
So I'm cherry picking here. But if you go back to the middle of 2018, which is, I don't know, almost 4 years ago, 3.5 years ago, the stock hasn't done well. So since the middle of 2018, the Qs are up 122%. The S&P is up like 80%. And Netflix, 43%.
That's surprising to me because I would have assumed they would have got a huge pandemic bump, at least in 2020, that would have carried them through a little bit more.
Well, 2020 was a monster year. So
you're saying other than that, they didn't do much.
Yeah, I mean, again, I'm definitely cherry picking because prior to 2018, it went on like a miraculous run. And even if you zoom out over the 10-year numbers, the numbers are very good. I'm just saying for the past 3.5 years, again, I'm cherry picking. It's underperformed Disney, which has had a ton of its own problems.
Yeah, it's also interesting that Disney hasn't done that much better because Disney Plus all came out in this time. So obviously the other stuff going on with their company has hurt it as well.
All right,
that is surprising.
So 150 million Americans have Prime. The last time they raised prices was 4 years ago when the price rose from 119 from 99. The prior increase was 4 years before that. This is from the New York Times, meaning that it might be time for another bump. And given that Netflix just did it, I wouldn't be surprised if Amazon goes as well.
Geez, look at this renewal rate. It says their renewal rate over the last 2 years is 98%.
No. Prime members, people that have been members.
For at least 2 years. Oh, who have been members for 2 years is 98%. Okay,
yeah,
gotcha.
Which is remarkable, but I do feel like this is less sticky than Netflix is. I feel like there is definitely a tipping point with Amazon where people are like, no, I don't need, like, there's so many more competitors.
Not for my household, but
we'll
we use Amazon Primes for everything.
What would the price have to go up to? So let's say that it goes to 140.
I'm like an auction guy right now. I'm just gonna keep doing this. I'm gonna keep bidding higher. I'm
gonna say like probably 200 is where I would start. Like, is this really worth it?
Okay. I mean, yeah, I would still pay, but you're right. Some people would.
But there's also like there are a lot of other competitors that you and I and a lot of other people don't know about because we're just so comfortable with Amazon. And I still don't understand how they're getting stuff to you in a day with a lot of the delays that are going on all over the country.
I don't get. There was something my wife ordered in the morning and it was there by that same night. It is kind of crazy how quickly it happens.
All right, let's just talk about crypto just for a minute. One of the coolest things about crypto, and you can't do this in the stock market, obviously, is seeing the behavior of individual buyers and sellers. So, for example, Glassnode did a post a week or two ago. One of the takeaways was only the holders remain. Like, you can see, you can't look at Apple and be like, wow, 20% of outstanding shares are held by people that have owned Apple since 2012. You can't do that. With crypto, you can.
Okay, so what are they saying here?
That a lot of the...
Well, I mean, do they have percentages or not?
Yeah, it doesn't even matter. But my point is that a lot of the newer money has been washed out.
Okay, so the people who've been holding the whole time are obviously still not selling.
Yeah, they don't sell.
All right. How about this? Crypto, like, if we want to make people truly love Bitcoin, Satoshi has like how many trillions in Bitcoin now? Isn't it some or billions or whatever? It's a ridiculous amount of money, right? However, why not airdrop that Bitcoin to like everyone who's in the bottom 25% of Americans? We're airdropping you your fraction of Bitcoin. to everyone. Creating a wallet for you. Satoshi hasn't touched that money anyway, whoever that is, he or she is. We're doing an airdrop of Bitcoin. Does Bitcoin immediately shoot up in price by 20% because you have a bunch of new people in it and using it?
I think it would have to be wrapped Bitcoin.
Okay. I don't know what that means. Okay, well, maybe this is what... So I think that there's a lot of really like bad faith crypto takedowns these days, but I think it's legitimate to like have a gripe of... The whole idea with crypto was, hey, financial intermediaries take way too much of a cut. Crypto is going to take care of that. And Matt Levine had this thing. He's like, I sometimes come across the claims that crypto will somehow disintermediate finance, that the decentralization of crypto puts the power and all of the economic benefits of crypto in the hands of ordinary people and gets rid of the need for big middlemen like Citadel. He said these claims are crazy. There are endless profile pieces of people who become billionaires starting crypto exchanges. He talks about the Binance guy who's worth $96 billion. The Sam Bankman-Fried is like the richest 29-year-old in the world. Brian Armstrong just bought a $133 million house. But so I think that idea that crypto was going to make everything cheaper obviously has not come to fruition. I don't know if it will. I think the point is there's always going to have to be a middleman in these markets to take a cut, to make sure this happens faster and more seamless, and probably especially in crypto because it's not that easy to use, right? So like, I don't think they're ever going to be able to get rid of the middleman in some of this stuff. If we're talking about wide adoption.
Yeah. But if you look at all of the accounts, and you could see this on Glassnode, all of the Ethereum, Bitcoin millionaires, there's tens of thousands of them, of people that, I'm not saying that they were brought up from poverty, but in a lot of cases, people got rich very quickly that otherwise would have never, ever, ever, ever amassed this much money. And here's what I want to talk about. A lot of these takedowns.
But don't you think they're all Silicon Valley people that are in that group?
Nope, definitely not.
I'd say 80% of them are. They have to be. That they would have been rich anyway. They already were. Like, or otherwise, how do they know about it? Like, how did you get into Bitcoin?
There's a lot of that, but I don't want to say 80%, but whatever it is, you're right. Of course. Okay, I'm torn on this one because on the one hand, I don't like the idea of judging something so prematurely that could be really game changer. Take Netflix as an example. Maybe this is a bad example. It probably is a bad example. But if you looked at Netflix prior to House of Cards and you looked at their streaming, you would say, this is dog shit. What are these like D-level movies from the 1990s that I didn't want to watch that I don't want to watch now? Think about how bad Netflix was. Now Netflix did change the world, right? It really did. Think about what it did to the movie industry, the entertainment industry, like at large. Like it really did. But the difference is nobody, maybe Reed Hastings aside, the entire world wasn't saying that Netflix was going to change the world. And so so on the one hand, I don't like judging something too prematurely. On the other hand, you're damn right people are going to judge when you're making these grandiose claims.
Yeah, you're right.
That Bitcoin fixes everything, that Web3 fixes everything, the creator economy fixes everything, decentralization fixes everything. No, it doesn't. Number one. And number two, if you're going to talk like that, then you're going to be a magnet for some bad takedowns.
Yes, I agree. Yes, it's like both sides are bad. That the bad takedowns are bad, and the people who say this is going to change the world and solve world hunger. Like, yes, I agree. Right. People need to like tone it down a little. But
yeah,
I feel like that's everything these days. If you want to get attention, has to be hyped. I feel like people feel that way at least.
So Galloway went in on Web3, and then there's the backlash to his backlash.
Yes,
and the truth is probably it's a tug of war somewhere in the middle. All right. We're back with great quarter, guys. Are you ready for this, Ben? I don't know if I'm ready for this. Another earnings season? Didn't we just do this?
We're going to break it up now.
All right, BlackRock. Congratulations. Great quarter, guys. They crossed $10 trillion. $540 billion of full year total net inflows.
Jeez. $10 trillion. I feel like they don't get talked about like in the same breath as Vanguard, except by like people that are deep into finance, right? Like, don't you think Vanguard just has a better PR machine than BlackRock? BlackRock seems more stealth about it.
I'm not sure. I have to think about it. I need to let that marinate. Okay. This stood out to me. 2021 revenue up 19.5%. 2021 employee comp and benefits up 19.8%.
Wow. Okay.
I think you're going to... What?
That's pretty neat.
I think you're going to see this a lot of employee comp outpacing top line, certainly bottom line growth.
Makes sense. And their net income was up 70. It was all... So like everything that they made, it kind of went back into the employees.
We never talk about this. We never talk about BlackRock, the stock. It's been a really good stock. not shockingly. So over the past, I guess I think I'm going back 10 years here. It's up 500%. The S&P is up like 330.
You're right. I never look at it really like that.
What if Vanguard was publicly traded?
Remember when Larry Fink was going to drive the bus off the cliff for the JNK or HYG? Which one was it? The high yield bond from...
What do you mean? Oh, who said that?
Carl Icahn. Remember he had the cartoon drawn of Larry Fink driving a bus off the cliff?
Oh, he did?
It was like 2015.
That was 2015. I wrote a post about that, and well, what doesn't matter. All right. What else do we got last week?
I did JP Morgan. There wasn't that much great. The financial ones I got to say are a little boring.
Boring, yeah.
But this kind of stuck out to me. So they, first of all, so BlackRock has $10 trillion. JP Morgan manages $3.1 trillion of assets. And that's in their investment accounts. That is an insane amount of money for someone we don't really talk about in terms of those other asset managers. Here's something that was interesting. So average loans at JP Morgan for the bank up 6%, average deposits up 17%. They also said the median household checking account was 50% higher in the summer of 2021 than in the months before the pandemic. So people should be probably going crazy right now because their assets are all up, interest rates remain low. People should probably be borrowing their faces off if you look at it on the surface. But they're really not. They're like, people are pouring more money into their checking and savings accounts than they're borrowing right now, which is still kind of bizarre behavior to me. Like there's not like some crazy credit bubble yet, even though it feels like there should be.
Oh, interesting. There's not a huge borrowing bubble.
Exactly. Like rates are so low, you would expect people to be borrowing and borrowing more and more, and it's just not the case. Whereas rates were like double what they are today in 2005 and 2006, and everyone was borrowing their faces off. And that was obviously that means credit standards matter way more than interest rates for this stuff.
We still haven't done.
Everyone was giving loans back then, and today maybe it's a little harder.
Actually, I'm going to save this we'll talk about this for the mortgage rates. So John Street Capital tweeted about JP Morgan, their earnings report. They spent $15 billion on tech, up 1.5 times over the last 3 years, enough to capitalize the 11th largest U.S. bank. All right, so you spoke about their $3.1 trillion in assets. They bought 55 IP and Open Invest to build algorithmic-based digital platform with tax efficiency and ESG investing. They bought a digital wealth manager, Nutmeg. Let's see what else they did. They partnered with Thought Machine to move the retail bank's core system to the cloud. Anyway, that's a gigantic number. I'm sorry, I misquoted. They spend $12 billion annually with guidance of $15 billion next year.
They're not messing around, huh?
It is interesting, this dichotomy of what legacy tech is spending on fintech and the performance of fintech, which Lindzen spoke about or tweeted about last week, just going the opposite direction. All right, Robinhood, what do you got here?
So they did this settlement with a guy who, like a 27-year-old truck driver, and they awarded this guy $30,000. I think he was making some claim about their buy button or something. And it was an arbitration, just a small amount of money, but aren't they going to have way more of these now if there's precedent for this? And isn't this a huge pain in the ass for the company?
What was the complaint? Was it specific to this guy? It can't be, right? Or can it be?
That's what I'm saying. There has to be way more of this. If it happened to one guy, other people are going to see it and go, that happened to me too. I don't know. I'm trying to look at the bull and bear case for Robinhood. So Howard Lindzen talked about this the other day in his podcast, and it kind of blew my mind. He was saying that the price to sales ratio for Robinhood is lower than the price to sales ratio for Charles Schwab, which I think Charles Schwab is trading at all-time highs now, and Robinhood is obviously way down to all-time lows, even though it just went public. I know that you can't look at one valuation metric on its own and say, like, this tells the whole story, but if you would have asked me who has a higher price, I would have said Robinhood is 10 times higher than Charles Schwab's without knowing the difference, right?
Yeah, I was looking at the PE. Schwab is at the upper end of where it's traded over the last decade. It's at 36 times earnings.
I guess that's the difference. Robinhood doesn't have a PE because it doesn't have any E.
So Robinhood lost more than $3 billion over the last 9 months. That is, by the way, this is when you talk about what's going on with growth stocks, especially companies like these that are just hemorrhaging money, that are relying on investors' good graces. Guess what? When interest rates are rising, there are no good graces.
Well, we talked earlier about the rise of retail investors. There are 25 million new brokerage accounts open in the last 2 years. How does Robinhood just get totally run over in a bear market? Like, do people still keep flooding money in, or do they go, whoa, this trading stuff is way harder than I thought, I'm out? Like, does Robinhood get just crushed if there's an actual bear market?
You would think, but there was just a really bad bear market in all of the names that they were trading.
True. That's true. Which is one of the reasons they're down so much right now, probably, right? Because their accounts are probably down way, way more than the market right now.
You were right, by the way. Not about Robinhood, but about Coinbase. It seems to trade very much in lockstep with the price of crypto, which I don't think makes much sense. Not that the market needs to make sense on a day-to-day basis, but you would think that during high volatility, even if it's volatility on the way down, that people are trading way more and therefore they're going to make more money. Again, I know that doesn't at all need to translate to daily price action. But
yeah, you'd think that would eventually go away a little bit. But if that's the case, if you're an equity holder, would you say, okay, why don't I just own Bitcoin? Or do you say, wait, Coinbase is a cheaper way to do it through the stock? Like, do people look at Coinbase as a proxy for Bitcoin and just say, I'm just going to own Coinbase then? Or vice versa? I'll just own Bitcoin and not Coinbase.
It looks like they are.
Yeah. Okay. That was just a guess. I'll take my victory up. That was just a guess.
Yeah. Credit to you.
I'll take it. Hey, so do you think you talked about the Silicon Valley show in 2014? I'm going to let it go a little longer than that. Do you think like 2019 was the all-time peak for Silicon Valley, the area? Like Silicon Valley peaked in 2019. Basically pre-pandemic.
Pre-Travis getting into trouble? Well, Adam Newman was New York.
I think that was the apex of Silicon Valley is 2019, because since then...
Why?
So this is from the Stripe CEO said that in Q1 2019, 39% of Stripe's hiring was outside the Bay Area in Seattle. Last quarter, it was 74%. I know a bunch of other Silicon Valley CEOs replied to this tweet and said the same thing. He's just saying that like this whole industry going global is still underappreciated and it'd be a huge tailwind for the world over the next decade. I mean, it's kind of hard to, if you follow a bunch of tech people that still live there, all I ever see people who live in San Francisco do is complain about living there. The crime and the homelessness, and they're not really, it's not like the Chamber of Commerce is really having a good PR campaign right now for moving there. It's expensive and there's homeless people everywhere and the crime is out of control, and it just doesn't seem like a very inviting place to live when you can kind of work from anywhere now. Don't you think that like the peak of people seeing Silicon Valley as this place I have to be is just over now? Especially since all the tech companies are going full 100% remote in most cases.
Yes, but this surprised me. So CB Insights had their 2021 State of Venture report. It said in 2021, $105 billion worth of funding in Silicon Valley was the number one metro area. So they said Silicon Valley, including San Francisco, is still by far the tech capital of the US. Startups raised $105 billion in 2021, doubling, Ben, listen to this, doubling what they did in 2020.
Yeah, that's just because there was more money that poured in, though, probably, right?
Well, so what? I'm saying it's still by far the biggest source of tech funding.
Yeah, that makes sense.
It was more than twice. It was twice what New York was.
Okay, I'm just saying, it's decelerating. It's going to go down.
Well, the relative gap has come down for
Yes.
sure.
Let's do some housing stuff. So we've been talking in recent, I think we asked a couple weeks ago, like, is it possible if rates rise that you can finally ding the mortgage market? What can stop the housing market? So this is from Redfin, and they say, actually, according to their survey, take it for what it's worth, anti-survey podcast, all this stuff, higher mortgage rates for 47% of house hunters say they would feel more urgency to buy a home if mortgage rates rose above 3.5%. Because they're worried that housing prices are going to go up and maybe mortgage rates keep going up higher. So it's kind of like if there's inflation and it's going to last for a long time, you buy stuff now thinking prices are going to be higher in the future.
That's inflation.
Yes, so that's the same thing here. I actually kind of think there's something to this, where if you've been on the sidelines and you go, wait, if mortgage rates are going to go to 4%, I'm buying now, and housing prices could get a bump. Look at this chart that I just put in here. I'm writing a blog post about this. Because in theory, if a discount rate rises, you would think a price would go down, right? If the cost of borrowing goes up, the financial asset price should, in theory, on a textbook, go down. I looked at these other instances going back to 1970. When the mortgage rates rise, what happens to the housing prices? Not once could I find an instance where mortgage rates were rising and housing prices were falling. In fact, the opposite. Every time mortgage rates rose, housing prices rose too.
Why? I have to think about this. How many instances? How many times are we talking about?
Look at my chart here. Probably 10 times. Because people don't buy a house because of interest rates. People buy a house. Think about it. Mortgage rates have been low for 5 years now. And it took a pandemic to get people off their butts to start buying. And now we have this huge groundswell of people buying houses. Rates matter more to finance people than normal people who just want to buy a house. Emotions matter. Emotions and where you're on your life cycle matter way more. So if you think about the early 80s.
I really don't know about that.
Look at this. 1977, mortgage rates were 8.7%. They went to 1980, they went to 16%. Housing prices were up 50% in that time. Obviously, inflation was up too. But why did that happen? Because a bunch of baby boomers hit their household formation years.
But yeah. Weren't down payments much more affordable for our parents than they are today?
Probably. I mean, housing prices were obviously way lower, but I'm not positive
I also
on
think
that, but
houses are so much bigger and more expensive these days.
yes.
Generally
My wife and I were
speaking,
talking about this.
generally
I think
speaking.
you and I hit this too. When we were growing up, I think we've mentioned this before.
Yes, nobody had a nice house.
No one had a nice house. And no one cared.
Even the nice houses weren't that nice.
No, yeah. I had plenty of friends growing up who they were the rich ones. Their parents were doctors or whatever. And it was like, it's an okay house. I feel like people our age and maybe lower really care way more about nice houses now than people did back in the 80s and 90s. That just wasn't a thing.
Yeah.
All right, someone sent us this. If you think the housing market can't get any crazier, it surely can. I'm not saying we're going to be Toronto, but this Ben Rabideau guy sent this to us on Twitter. There's about 3,000 active listings in Toronto, which is a half a month of inventory, and there's 60,000 active realtors in Toronto.
This makes no sense. How?
I don't know. Obviously, everyone just decided to become a realtor, but I don't know. That one has to be the craziest housing market in the world, right? It has to be. I'm sure that maybe there's some.
Somebody sent this to us. Canada's not on here, but it's a chart from the FT, I think, showing housing assets as a percentage of GDP. Why does this wording confuses me? Housing assets? I'm assuming this is just housing, right?
Someone in London must have written this.
Okay. Yeah.
By the way, it looks like someone took a picture of this from their actual physical newspaper and sent it to us. It's pretty impressive.
So it's showing, again, housing as a percentage of GDP. Japan, the US, which are both over 200%.
It's amazing how much lower Japan's is.
And the
that 89
right.
peak.
Yeah, it's amazing. And the UK, which is 400%. I don't know how many listeners we have in the UK. Somebody could explain this to us. What the hell is going on? It looks like there's the gigantic housing bubble in the UK.
It's just that's my whole thing is that if you think the US is crazy, look elsewhere. We get emails like this from people a lot in other places saying the US looks tame by comparison. That's why.
Fine, but you saying that acts as if people are choosing to live here or the UK. Nobody. So it's erroneous. It's erroneous on all counts.
No, but my whole point is if you think it's crazy now, it can definitely get crazier.